Okay, no more question. Then we will be starting chapter 2, which is the international flow of funds, right? So we would be explaining these learning objective. So let's just talk about the international flow of funds. Give me 1 second so that I can just change the screen because I need to write it down, and it would be very easy for me as well. Here we go. Okay, so our first learning objective is the balance of payment. So the balance of payment definition is it's the summary of transactions between domestic and foreign residents for a specific country over a specified period of time. So what was our learning objective first? That is to explain a key components of balance of payment. So we have one country, country A, country B. Of course, there are people here. There are people here as well. Okay, so due to this international trade, this Earth has, is called now is becoming global village, in which you can buy, products from other countries to your local store as well. So what actually goes, the things, the products are going from one country A to country B. What country B is giving to the country A? Value of the product, right? Which is money, right? So there are a lot of there are many products, like products or services, right? Services as well. Country B will have to pay to country A the price. Similarly, from country B, people are also getting some products or services. And country A is also giving them the value of the money, value of the product, right? So balance of payment. So balance of payment is just like, the calculation of stuff that, okay, from US, how much is our trade, how much we bought, the raw material, how much we bought, how much we sent the finished goods over there, how much total services from, banking services, the lawyer services, the other services as well. So it's a complete, it's like detailed balance sheet. If you go through this accounting stuff, so you understand what is balance sheet. So this is basically the balance sheet of the country, right? So how much we pay for imports, how much we pay for exports. We'll just talk about the import and export. So let's first, the components of balance of payment. Number one is current account. Number two, capital account. The current account, it summarizes the amount of purchases of goods or services or the provision of income on the financial assets. So basically, it provides the summary of flow of funds, that how much you purchased, or what is the net purchases from the other country. Okay, and the capital account is basically, it summarizes the flow of funds resulting from the sale of assets between one specified country to all the countries over a specific period of time. For example, you are selling your airports, you are selling your national bank, right? You are making it privatized, and what happened? For example, the water supply company, Shanghai Water Supply Company, the government of China, say that we are going to make it private. And one party from, for example, in Korea, they want to purchase that company, or the subway, Shanghai subway. Now the government of Shanghai sold it to US company, So that sale purchase is under capital account. Okay, because that is the national asset. No country is selling its assets, and that assets are purchased by other countries. So that amount go to the capital account, right? So we have further segregation of current account and capital account. But before that one, we have a very nice video that will summarizes all this. So we will be seeing a lot of videos regarding the concept, so that you further gain, the real knowledge, what's going on, and how we are going to apply this knowledge here. So I have a very nice video from Investopedia. I hope it will further clarify your concept regarding balance of payment. Here we go.
The balance of trade is the difference between a country's imports and exports. A trade deficit occurs when a country buys or imports more goods from other countries than it sells or exports. The expenses going out of the country for imports is greater than the income coming in from exports. While a trade deficit could be an indication of less revenue being generated and hence resulting in a lower standard of living in the economy, it could also be a sign of economic expansion. When a country is going through an expansionary stage of its business cycle, aggregate income increases, which can trigger a rise in the demand for imported goods or services. A balance of trade deficit is favorable for domestic consumers as they enjoy a greater selection of goods and services at competing and lower prices. A trade surplus occurs when a country sells more than it buys from foreign markets. This means that the revenue coming into the country from exports is greater than the payments going out for imports. More revenue usually leads to a rise in employment and wages, which is prosperous for any economy. A surplus may also arise when an economy's business cycle is in a contracting stage. In this stage, aggregate income decreases, leading to a subsequent decline in the demand for imported goods. If exports remain unchanged, a surplus emerges. A balance of trade surplus is favorable for a country's domestic producers as they generate higher sales, more revenue, and increased profits. When combined into a single figure, an economy's trade transactions paint a useful picture of overall trade activity, helping investors identify trends.
Okay, so let's just talk about the components of current account. So let me just, okay, first we talk about here. So current account, number one component is the payment for merchandise and services, which is called trade balance, which we just learned from the video. Okay, that is not the balance of payment, that is trade balance, which include the exports minus imports, the net effect, right? So this account, the part of current account, is trade balance or payment for merchandise or services. So merchandise exports and imports represent tangible products that are transported between countries. Service exports and imports represent tourism and other services. So that difference between total exports and imports is referred to as balance of trade, right? So here we go. Okay. Second one is factor income payments. So it represents interest or dividend payments received by investors on foreign investment in financial assets. For example, the people of the country, they bought the bonds or interest bearing securities or have invested their money with the US banks. If you are in China and you invested in the US banks, or you fixed your deposit in US bank, and you are receiving interest payments, right? So in receiving the interest payment, it means money is coming to the China, right? So that would be not the balance of trade. That would be factor income payments. And number three is the transfer payments, which represent aid. Right now, China is going through, under heavy flood. So they have a lot of losses. If some country, send some aid in terms of like money, so we also add it here. Transfer payments, grants, gift from one country to another country. For example, the Russian president sent some, helicopters and as a gift to the Chinese, government, or send some cars, or send some mobile phones, to the other countries' officials for the gift. We call this transfer payments. So let me explain what we have learned in our video. So if you want to keep track on country, sorry about my bad handwriting. Let me erase it. If you want to keep track on country, so you have its current account and you have its capital account. That how country is doing well, and we can find out whether the country is doing good or bad through the inflow and outflow. If money is coming in to the country, we call this inflow. If money is going out from the country, we call this outflow, right? So inflow funds coming to the country is good. Outflow of the funds going out from the country is bad, right? Similarly, with the company, you want to increase your sales, you want to decrease your cost, right? But we cannot say that this is country's sale or the country's expenses. We measure this in terms of inflows and outflow, like flow funds, right? Under current account, we have three things. We have balance of trade or trade balance. We have factor payment. And we have transfer payment. Right? So the biggest chunk of this current account, it is the balance of trade. Because not all the people of the country, they are investing in foreign countries, they are saving their money with the foreign country. The majority is dealing with the balance of trade. Only few people like politicians, wealthy people, they are saving their money with the foreign country and earning interest, or they are buying the shares of other or foreign countries. They are very wealthy people. A few people, if you talk about the majority, maybe 2 or 3%, not more than that. But majority of the current account is coming from balance of trade or trade balance. And there are very few number of transactions with transfer payments, because it's not a the routine of the country to receive aids, or having some natural disasters on routine basis, or receiving gifts from or paying gifts on a routinely basis, right? But the amount is not that heavy. It's a very small portion, maybe 1 or 2% of the total current account. So the major part is balance of trade. So how we measure the balance of trade?